So I think what I presented you is now like the complete system. If you have a system like that, what would you consider would be like the new frontier of such a system? What is the next frontier? The question. What if you think about the system as we have it now and you have used it in terms inside the bank? You have your little bank, so to speak. So what if your imagination would go on? What would be the new frontier? Have you reached? Yeah, I said now the system is complete. It sounds very end of the, so we have reached the goal. But I think there's a very important new frontier yet to the system here. And I just want to trigger your mind a little bit to think about what could be the new frontier. Somebody has an idea. The new frontier, so far we applied the system in a bank. So you model your bank, and I think we can do a pretty good job here. So we have a big thing. So the next frontier is to jump outside the bank, going on the systemic level. And this level has been triggered with the last crisis. I went in 2004, first time to Swiss National Bank, and I presented them the system. I said, you should take it to the systemic level. First, I explained them, and they were very happy, and said, oh, it's a good system, it works, you can see. And suddenly they got a little bit pale. And one said, oh, are we going to see then? Are we going to understand then? I said, yes. So they got totally pale, and they really shied back. I went the second time and they said me explicitly, we don't want to understand. The banks know better how to control themselves. So that was basically the answer, 2004. You should ask the same guys in 2008. And at that time it was like that. The typical situation if regulator and bankers met, so there's a table, here sits the banker and here the regulator. The banker earns 2 million, the regulator 100,000. In the financial world, that means he's 20 times more worth than you. It's very simple. And that was about the relationship between regulator and regulator. And every regulator wanted to sit on the other side of the table. So basically he only was there in the regulation to shift the table, to get on that. That, I think, made everything possible. I don't think that the regulators regulate the banks, but the banks regulated the regulator. They told them more or less what to do. And you can say it was a regulation crisis. The regulation was cut back. And to the point where then people do whatever they like. Any leverage, any type of business, any type of risk. So the thing has also a lot to do with regulation. So the financial crisis revealed that the government is owner of last resort. So whenever the thing has no value anymore, to whom does it belong then? To us. So then we get it. So it goes to the government. So if you are the owner of the last resort, you should understand. You should know what you own in the bad case. So it's not just checking, like Big Brother. It's just making sure that you don't own the thing in the wrong moment and making it less sure. And we can say regulation failed utterly in that. And there was a real drive for new regulation. Now that goes a little bit too far. I can't explain you everything. But I guess, I think I've been talking about Dodd-Frank already a little bit. And inside there you have this financial stability thing. And inside financial stability, it's called the Office of Financial Research. That is what you have to see. And in Europe, we have the FSB, the Financial Stability Board. That's the same, like the OFR. So the FSB, the Financial Stability Board in Europe, and the OFR in the US. So their aim is to know enough, or at least to know about the financial system that can be known. So that is the task. Now, if you go back, if you look here, the 19th century, how the regulation has been driving up more and more regulation. So it looked to many people that the biggest risk in finance was what? regulation itself. So now the real risk is regulation, you know, so that kills everything. And actually there's a banana skin report that's from PwC and some other thing. So they make a report every year and ask, what are the biggest risks? You know, they ask hundreds or thousands of bankers. And you see, 2005, 2008, 2007, always regulation itself was considered the biggest risk. You know, whatever little regulation was still there, the banker said, oh, that's too much. We don't want, you know, you block us, you know, we are driving, you know, we want to do much more. That changed a little bit in 2008. Suddenly, that dropped to place 8. And the real risk number 1 was liquidity, then credit risk and credit spreads. So that was the risk in 2008. 2009, when it got better already, again a little bit, again, regulation got already place 3. And 2010 as well, place 3. In 2012, 11 they didn't do. Again, of course, now we are again in troubles. Now people think regulation is not such a big risk. There are other bigger risks around here. So regulation is seen something as a negative. So it's what we need is really not more regulation, but smarter regulation. And I believe that. I think really regulation can be a drag, you know, a pain. What we really need is smarter. And if you look at regulation, you can compare it to any other industry. I think the banks are by far the worst regulated part. And it's a public good. You know, and it's something where the government plays a role. They print the money, they do all that. You know, it's not something where you say, okay, keep the government out. The government is in anyway. You know, they do everything, and then owner of last resort. And we have also a very dumb type of regulation. You know, stupid. The idea of the UfA, as it was intended, at least, and of the FSB, is to change regulation really. Now we will see how. Okay, so to see how it has to be changed, we have to see also the new tasks of regulation. So first of all, with this, really the question of systemic risk came up. For example, Paulson, when he decided about Lehman Brothers, in the morning to drop them, he didn't know about AIG. This he learned in the afternoon, which cost 150 billion for one firm, imagine, for one firm. So he didn't know that. Huh? And it could have been known if you build up a system cleverly here. And what also came clear in this crisis, the need for stress test. Now they did stress tests, but they are very cumbersome exercises, the way, and very unreliable in terms of quality here. And that the regulation has to change from a backward-looking custodian of some balance sheet ratios to a forward-looking global risk manager. This is what risk management or regulation should be. A regulator should be like the global risk manager. So what you do in a single bank, just lift it one level higher. And not just you let the numbers sent to you from the banks and you look at it a little bit, you try to aggregate a little bit. So if you look at this famous picture we know, current regulation, or the old regulation, let's put it like this, was focusing on the analysis elements. And it would ask from the banks to send the information. Basically, they were always asking for value, and normally book value. Or be it market value, I don't mind. Huh? But a market value is already passed, and it's a number, and what can you do with that number? What can you derive if you have compressed all the information into that number? You cannot derive anything anymore. In order to derive, what has to change? The focus has to go from here to here. And that is really the change, and that's a drastic change. That is not like between Basel I and Basel II, that's already big, Basel III. That is really a refocusing. You could call it a Copernican revolution, you know, like getting a new center of thinking. You start with the causes and not with the effects. And it would be actually very logical to start with the causes and not with the effects. But the world is not built, the financial world hasn't been built like that. So first of all, the focus shifts up. Say, we have to have that information, and then we can do stress scenarios. Basically, and the banks only have to give us this information, and we do all the analytics ourselves. From our perspective, they might make different assumptions, that's fine. But we will do it from our stressing and see who can survive how long and how is the systemic effect of the total. So, and given from them, so then the main focus goes on contracts and actually on contracts and counterparties. These are the two things which will be now collected quite differently. Market is already standardized, so that's why it's not part of the thing. Market is already good. And behavior is a bit special because it's statistic. So that's an open dimension, so you cannot collect data of behavior just like you collect data about yield curves or something like that. So, but the real progress happens in these two dimensions, contracts and counterparty. So here, so it will be on single contract level. That's written in law, so it must come really, although politicians still can disturb quite a bit. So you can write something and something else comes out, so that's a little danger actually. And what happens that we get standards organized on LEI. LEI. LEI stands for Legal Entity Identifier, that's the counterparty information, and the contract types. So that's basically the thing. So it's all about standards. And this is a good standard, for example. You know, in the 19th century, mid-19th century, every screw had its own bolt. Basically, if you just lost a few, you know, you had to try whether it will fit again. So that has changed a lot by having those measurements here. And in terms of comparing to screw and bolt, the bank is still in the 18th century. So we are still about 19th century. We still, every financial contract has its own expression. Although they are the same all over the banks, you use different words, different, you know, little algorithms, everything is different. So we are about screw like in 19th century there. Another good example of a good regulation is like water. Here, I take Perrier, you know, there was once a recall because they had a little benzol or whatever in the water, you know, tiny, you know, and they called it all back. And the difference between what happens with water and finance, water has a language, or food has a language, for example, and finance has not. I mean a common language. And what is the common language? Chemistry. You know, I think even though we are not chemists, you know, but we can read it somehow. So everybody of us, I think, can read it. So we have these little symbols, and gram, we know what it is, and so on. So we have a common language. And so we are missing that language. So we have to, so what basically will happen the next few months, years, is that financial standards will be set, and the two bodies which will do it, or should do it, are the OFR and the FSB. So, and they standardize the LEI, that happens now already, and contract type is lagging. So we are pushing like really very, very strong now that this should come. Actually, we are on the way of making a big push there. So the dimension of the project, you know, imagine now let's first in the US, now in Europe, so that's basically the whole world. So if Europe and the US does it, so China will come, India will come. So you have every financial contract on a single contract level. It's a few hundred million or maybe a billion or something like that of financial contracts floating at every moment. And the idea is to have a daily analysis. So every day you know what kind of contracts are out there, how they generate cash flows depending on the risk factors, and how they are related via the counterparties. So it has been, this is Fort Alamo, so something like here, it has been compared to CERN also. I think it's really smaller. I think the task is much easier than CERN, really. So there is some estimation which says it costs about $600 million a year. I even don't think that you need that much. Okay, because they're bureaucrats, so maybe that's why it's so expensive. I think you could do it with zero less, I'm very sure. But anyway, you need big computers, and of course, very well programmed contract types, and highly efficient, etc. So that's the aim, and then the regulator is the risk manager, basically. So he can look at single banks, he can look at the entire sector, he can stress an interest rate, for example, and see how each bank is reflected. He can do a stress test on whatever and see how each bank is affected. So a first round effect you can purely calculate. Then of course comes the second round effect. How do banks react, etc., etc. And then you need models, again. So they will react like that, and of course then it becomes again a little bit fuzzy. But first round you can see immediately. So not only, so that's the profit for the regulator, but not only the regulator will profit. So that is between banks and regulators. So that's the first thing. That should set the standards. There will be a high profit between banks and banks, because now you will, if you have the data and the algorithms, they represent the true contract, because the algorithm which generates events is the true contract. The lawyers just have a strange language to express it. But in reality, they say, if this, then that, and if the rate this, multiply this. That's what they're saying, nothing else. So the true, and that is now common for everybody. Actually, it should become open source, of course. That is what we are striving for. So there will be much better understanding between banks. And not only between banks, there will be much better inside the banks, because you have the same problem inside banks. Different departments already model it differently. And last not least, between the banks and their customers, their investors, etc. I believe once the idea of contract types has been fully evolved, I think everybody can understand finance. Much easier. I always said, at the end of the day, the cleaning lady will understand it. So it's everybody in the bank, so that there's no restriction. It's not that difficult. It's only made difficult. We just have to simplify it and to do it the way it's really done. Yeah, there will be big profits for also all the market participants. Imagine here, this is a CDO in the CDO square. It starts here. Here, these are the loans. Somewhere in, say, in California, given housing loans. And then the green part here, this is then the retail mortgage, somehow MBS, mortgage-backed security, retail mortgage-backed security. That means you just collect those together. And you combine them a little bit in groups, like you would take all the mortgages for teachers, which are between 30 and 40 years old, or something like that. But as you move already from here to here, almost all information for you is lost. You only know teachers 30 to 40 years, and maybe 10-year mortgages, something like that. But there's, of course, a lot of difference in there already. And then this is further packaged in ABS CDO. So they package and they slice it. So they take the upper 85% is AAA, was AAA, not anymore, and the lower 15% is not AAA. So that's how they did it. And then they made even CDO squares. So CDOs from CDOs. What do you know at the end of the chain? Nothing. You know a value, which is given to you just like that you accept it. Yeah, that's basically what it is, you know. And you have no clue anymore. Now, if you have a system like that, you store basically the information here. And you know everything, you know contract type, events, etc. And here you just refer back. Oh, sorry. So you keep even here you would see how many of those you have. Because it refers back. So you would only, and there would be a central store of that information, and you can see the cash flows throughout. So, and there's a very good thing. I also said we don't need a system that covers 100%, but we should cover about 99+% for the precision. So there will always be, and especially if you set up a standard, of course, what will the market try to do? Invent things outside the standards. Yeah, and there we should catch them. So the idea here is, but that is not yet regulation, but I think it will come. You have standard contract and you have contracts which are outside the standard. If you want to go outside the standard, go outside the standard, but pay. Because you do deals which are uncontrollable, so they are more risky. So how do you pay? By higher capital charges. And if the deal is good, you can do two things. You accept the higher capital charges, it's still worthwhile, or we standardize the contract. And because it's open source, so the banks can contribute themselves. So then we come into this here, into standards here, which are less charged. But even inside there, if you have now contract type, you can understand the complexity of every deal. For example, if you have a PAM, principal of maturity, that's the least complex. You know the cash flows, PAM fixed. PAM variable is a little bit higher, or an option is already higher. You have volatilities, you know, less reliable. And if you would have options with correlations, it's even less reliable. So you can order contracts by complexity. Meaning complexity, how do you depend on assumption? And the more you depend on an assumption, the higher should be the capital charge. And that's a very logical thing. Because the more you depend on assumptions, the more risky the thing is. So the capital charge is increasing from here to here. But that's a little dream yet, huh? So that's nowhere written down, but I think it's a logical consequence once we have a system like that. Yeah, so for the banks, we have the benefit. This is still the bank of today. You know, data, typical analysis, all big chaos. So we should bring it to that. At least you see a little bit into the future. I don't believe that we will see totally in the future, especially because of the risk factors. The risk factors will remain a risk, but we have at least encapsulated things which are certain, you know, and can play better with the factors. That's progress. I'm not promising you a complete world. Actually, I wouldn't like to live in that one, so it's good. But a better world, I think, can be achieved. Yeah, so we are coming to the end, and I hope you have still got some new ideas about finance and what can be done. And of course, now you can go back to your models, which I know you like much more, which is also very good. But I think you need also some theory. You know, the theory gives you the background to think, and the model really helps you to understand in detail. So Yanis is back here. Thank you.